So good morning, everyone. Welcome back. Today in day 4, we'll be revisiting the pillar of borrowing. So we're going to be exploring loans and credit in much greater depth. So a few things before we get started. Yesterday participation was great. Let's keep that up for the last 2 days. Participation is pretty important for a class like this. So yeah, just keep participating. Feel free to raise your virtual Zoom hand and ask your question anytime. I don't know if Matthew is here right now, but if you see him, feel free to send him questions. I usually can't check the chat very often, so yeah. Camera's on. When he does come in, hopefully, he'll be checking that as well. So make sure your cameras are on if you can turn them on. Turn in after class work. Yeah. So I know that a lot of people are running behind on their after class work. I just hope that by day 5 that people catch up. We're going to be pretty lenient on that. So just make sure you turn it in. And then we'll look at what you have, and then it should be pretty good. So let me see. All right, before we get started here, I wanted to go back and check in on day 3 work. How many people raise your hand if you did the day 3 work already?
Me.
Okay, Sarah,
I
Sean.
did.
I did.
Did you mean? Okay. So not a lot of people, but great job to the people that did. Let's go ahead and actually look at day 1. So this is not day 1. This is day 3. Okay, we're looking at day 3. So number 1, would you rather have $1 now or $1 tomorrow? And why? So obviously $1 now, right? Very basic concept of time value of money. Because what you can do is you can put that $1 now into some investment or some savings account that yields interest. So very small difference, but you would still rather to have it now than later. If the annual return rate of investment is 8%, would you rather have $50 now or $55 in 1 year? Now this is an interesting question because it's asking you to compare 2 different values in 2 different times. So what you could do is either calculate the future value of this in 1 year or the present value of this. So I think the more intuitive one is calculating this. Yes, Andrew.
I just did the homework like today. I never saw there was any like the $1 now or the $1 in the future question.
It should be the same form. I'm not sure.
I submitted the form, but like if I didn't fill out that question, it would have said like that.
It's okay.
I don't know. I think maybe it's a mistake that I just forgot that I did, but whatever.
Okay, I mean we can check it later. It shouldn't be that big of a deal, but if you know it's right, then so for this, back to this question. So we want to calculate the future value of this and compare it to that. So then we want to compare things at the same times, right? So let me go to scientific calculator. What did it say here? So $50 now or $55? So $50 now, 1.08% in 1 year, and that gives me $54. So 55 is greater than 54, so I'd rather have $55 in 1 year. Does that make sense? Okay. If you wish to accumulate $140,000 in 13 years, how much must you deposit today in an account that pays an annual interest rate of 14%? Hold on here. Okay, so for this one, very straightforward present value problem. I believe, let's see how many. Okay, so 4000 divided by, Matthew said he'll be joining us soon, so just a quick update on that. 1.4000 1.14, 13. So that gives us $25,000, 280, sorry, $25,000, 489 and 71 cents. Does that make sense, everyone? Just raise your hand if you need any clarification, and then we'll sort it out. But seems like people are on the same page about this. All right, moving on. So these are, I think, getting a little harder. What will $247,000 grow to in 9 years if it is invested today in an account with an annual interest rate of 11%? Never mind, I think this is a little easier. But this is a very straightforward future value problem, right? So you have, what is it? 24700, 1.11, oops, 1.11 raised to the ninth. And that should give you 631,835 and 12 cents. Okay, here's a bonus question. If you wish to accumulate $197,000 in 5 years, how much must you deposit today in an account that pays a quoted annual interest rate of 13% with semi-annual compounding of interest? Here's how you do this. Remember, when we have non-annual compounding interest, we have to divide the interest, the quoted annual interest rate, and then also ensure that the exponent, or n, the number of periods, matches our new periods. So let's see, 1900, 1 plus 0.13 divided by 2, because this is semi-annual, raised to, can anyone tell me what this would be raised to? Raise your hand if you think you know the answer. Sean.
The ninth power?
Why the ninth, Sean?
Because this is in 9 years.
We're on the bonus question here.
Oh, sorry, then the fifth power.
Well, not exactly. Sarah?
The 10th power?
Yeah, it would be raised to the
Because
10th.
it's 5 to the, because it's compounded semi-annually, so it's twice a year.
Exactly, right. We're looking at the number of periods, not the number of years. Esther, is that what you were going to say?
Yeah.
Yeah. Okay. So there you have that. $369,796. So that's the homework for you. Make sure to turn that in. We're not grading on. We're mainly going to be looking at completion. Because I'm reviewing the answers while many of you still haven't done it, so it'd be kind of unfair for the people who already did submit. But let's go back to this. So let me stop my share here. Go back to the presentation. Matthew, are you here yet? Yes, not. Okay, let's move on. So
sorry to interrupt you, Ryan. Did Matthew give a heads up, say why he's not here right now?
Yeah, he said he'll be joining us in a few minutes. So I just wanted to check in whether when he was here or not.
Okay.
Yeah, no worries.
Sorry, I just had some stomach issues, my bad.
Okay. All right, let's start with our agenda. So a few things to cover today. We're going to first look at types of loans. Then we're going to look at credit, credit reports, credit scores. Then we're going to look at, understanding loans in real life, a lot of real world issues that's going on with loans right now. And then we're going to look at a game where you're simulating trying to finance your college education. So a lot of stuff to get through. So let's just get to it. So let's start with types of loans. So the first type of loan, let's look at personal loans. So remember how loans and amortization work from last class? Well, a personal loan is simply an amount of money that an individual can borrow for a variety of purposes. So very straightforward, just like how we discussed from yesterday. There are countless reasons why you may need to take out a personal loan, medical bills, wedding expenses, debt consolidation, which is where you combine multiple debts into a single debt for ease and perhaps a lower interest rate. Home renovations or repairs, vacation costs, and just in general, unexpected expenses, right? And this goes back to what we were saying on day one, where we were talking about, why do we borrow money? Because we don't have enough and we need more for whatever reason. And these are a lot of the reasons why. Personal loans can be offered at many different financial institutions, including banks, credit unions, online lenders, and what are called payday lenders that may also be engaging in predatory behavior. So remember Shady Sam from yesterday? That's what we were. We were a payday lender that was engaging in predatory behavior. So here's an important thing that you all should know. Personal loans are usually unsecured, which means that it doesn't require any collateral for you to borrow the money. So what's collateral, right? Well, collateral is an asset that a lender accepts to protect themselves financially if the borrower fails to make the loan payments. And we'll look at examples of collateral and other types of loans here. But what you need to know here for personal loans is that there's usually no collateral for personal loans. Okay, auto loans. So before we look at auto loans, I have a quick question for you all. Do any of you know what your dream car is, and do any of you know how much it costs? Because cars are quite
my
expensive.
dream car is like probably a GMC Arcadia Denali at most, and my first car I'm probably gonna rent. Since,
Okay.
like I know that the value of the car greatly depreciates it even when you like just take it off the lot. It decreased by 45% or something like that.
Yeah, that is absolutely right. Cars are a deteriorating asset, so they're not an investment. But Harrison, thanks for the response. So make sure to raise your hand so I can call on people next time.
Sorry.
Yeah, no worries. Sean?
For my first car, I want a Jeep Renegade because its backlights look kind of cute. It costs about 25,000.
25,000. Okay. Jenny? Jenny, do you have a dream car for us to share?
Yeah, it's SUV, and I'm pretty sure it's about like $1,000 or $100, but I am not sure. Maybe it's like over 100.
$100,000. Is that what you're saying?
No,
Not $1,000, right? That'd be. I mean, I'd go buy the SUV right now if it's $1,000.
it would be like 20,000.
20,000. Okay. Yeah, makes sense. All right. So dream cars, pretty expensive. Not usually something that we can easily afford, right? Nav? Nav?
My dream car is a McLaren, and it's probably like, I don't know, like more than $500,000.
Yeah. So Nav is dreaming much bigger. Relatively sweet. I don't really have a dream car, but just for something that I've been looking at are Teslas. Here's a Tesla Model S. It starts at $69,420. Very expensive, right? So in general, cars are very expensive purchases. So auto loans allow consumers to pay off their cars with fixed monthly payments rather than pay all the cash up front. And they're usually these loans are usually offered by established financial institutions such as banks and credit unions. And here's where we talk about collateral, right? Because remember, personal loans, no collateral. Well, for auto loans are secured by the car as collateral. And what this means is that if you are unable to make your payments, if you start to default, defaulting means you can't make your you can't pay back your loan, or you're unable to fulfill your debt, right? That's called defaulting. So if you default on your loan, if you default on your auto loan, then because the car is collateral, the financial institution that lent you the money, it can actually possess the car. So it's going to be their property. So, if you don't make your auto loan payments, what can likely happen is that the car gets taken by the bank if you took money from the bank. Does that make sense to everyone? Does everybody understand what collateral means now? Yeah. Nav, you still had a hand?
No. That's all.
Okay. All right, all good. All right, let's talk about student loans. So now, my question to you all, maybe not specifically, but what is your dream college or post high school experience? Like, where do you want to be generally? Like, maybe not like a specific school per se, but like, what do you want to do after high school, right? And do you know how much that lifestyle might cost? Any takers? Harrison?
So I want to go to Michigan University, right? Up in
Okay.
Ann Arbor.
Yeah.
It's about 43,000 yearly for the classes, and including, I'm probably guessing, let's say $20,000 on food and bills and like
Well, Harrison, are you
like
in
the
state or out of
rent
state?
and stay. Oh, right. Then it'd be like 32,000 if you're in state. So 50-some thousand a year.
Well, we'll actually look at the University of Michigan's tuition, and you'll see the numbers in just a quick second. But no, that's a really good answer. Yeah, college is expensive, even if it's a public university like the University of Michigan. Jenny?
I would be going to Michigan University, and
Okay.
right now I am searching on the web for how much it costs. It will cost like a few thousand, or yeah.
Yeah, so a lot of University of Michigan fans. Anyone else thinking about what they want to do after high school? Well, there are a few options, right? College is a huge one for a lot of people. Some people, college for 4 years. Some people might decide to go to vocational school or community college for 2 years. Some people might decide to join the military. Some people might decide to just enter the workforce immediately with your diploma. Though the options are a little limited, but there are a lot of different experiences after high school, right? And you want to pick what's right for you and what you want in your direction of life. And you also need to know how much it costs, right? So how much does college cost? Well, quite a bit. The University of Michigan's tuition is $15,000 and $558 in state, and $51,200 out of state. So for those of you who are in state and want to go to University of Michigan, you're in luck because it costs quite a bit less. But it's still quite a lot, right? Let me think. 4 years of in-state tuition would be one Tesla Model S, right? So student loans are essentially intended to cover the cost of tuition, books and supplies, and living expenses, while the borrower is in the process of pursuing a degree, right? So that includes, transportation, food, drink, all that stuff. So these are quite expensive stuff, and you might need to take out a loan if you're unable to pay the cost up front. So there are two types of student loans, federal and private. Federal are offered by the government, and private are offered by private institutions, like the banks and credit unions that we were talking about earlier. And these are unsecured. There is no collateral for these, so it is quite dangerous if you default. And we'll talk more about the dangers of defaulting later on when we talk about credit. But yeah, so these are unsecured. If you default on your loans, a lot of bad things can happen to your credit, and we'll talk about that later on. And you might be in like quite hot water financially speaking. But there's student loans. Are there any questions? Harrison, I see a hand.
No, I accidentally forgot to put it down.
All right, yeah, no worries. Okay, if there's no questions, we'll keep going. So let's talk about mortgages. A lot of you were bringing up mortgages in the last few days. Let's talk about it. So here's a discussion question. Do any of you know what your dream house or dream location to live in, right? And how much do you know how much it costs? Would anyone like to share?
Do I share again or no?
Okay, Harrison.
Okay, so my dream location is Michigan, and I want to cause I want to live in the house that I live in right now, cause me and my dad are doing a lot of things like growing fruit trees. So I think it'd be great to live in and stuff. So yeah, and I gotta ask him how much it costs.
Okay, good answer. Does anyone want to move out of state? To a major city or to another state, anywhere? Dante?
I want to live nice and alone in Alaska.
Really?
Yes. Surrounded by cold and wilderness is the dream. And the average medium house is $300,000.
What do you envision yourself doing in Alaska? What would be your job?
I want to do 3D rendering.
Yeah, so then you can work anywhere.
Yeah.
Yeah, that makes sense. I'm kind of the opposite. I'm thinking about moving to a city, but perhaps not within it, a suburb. But those, and this is something that pertains to this class, is that real estate near the cities and in the suburbs is quite expensive, right? So you might need a mortgage to kind of finance purchasing a property. So costs a lot, right? So what I have here is the S&P Case-Shiller U.S. National Home Price Index. And what this tracks is it's basically like an average of home prices in the last, going back to around the 1980s, right? So as you can see here, and this is adjusted for inflation, by the way. So these are actual prices rising, and it's not because of inflation. So we have here, in general, you see a general trend of house prices going up. So property is getting more expensive. Homes are getting more expensive. And we see this curious little bump here where it went up here, but it also went down. Does anyone know, and raise your hand if you do, does anyone know what happened here and why there's a bump here? Raise your virtual Zoom hand so I can see. Ella?
I think there was some kind of minor depression or something.
Yeah, a minor depression, also known as a recession, right? So yeah, does anyone, okay, more details? Esther?
Wasn't it because there was a housing bubble and the prices kept on rising until it burst, and then there was a recession?
Yeah, there was a housing bubble, and it burst. As you see here, house prices rose and they burst. Does anyone know why it caused it? Why this housing bubble happened? Nav?
I'm pretty sure it's had something to do with the stock market, and so everyone rushed to pay their bank fees because the bank couldn't keep up with the stock market crashing, and so they didn't want the bank to close. But when they paid the fees, they didn't have enough money, so the bank took their house.
Yeah,
something like that.
Kind of what you're describing as a bank run. That's not exactly what happened here. A stock market crash. The stock market crash was more of I'd say a symptom of the crisis rather than a cause of the crisis. Very similar to what happened in 1929 with the start of the Great Depression. People are like, oh, the crash of the stock market was what caused the Great Depression. That's not exactly true, right? There are a lot of underlying reasons for the crash. There were a lot of underlying reasons for the depression. The crash was only a signal that things were going horribly. So it's not exactly a cause, but a symptom. So very similar to what happened in 2008. All right, Sean. Oh,
Oh no, I was gonna say what everybody said. So
okay. Yeah, no worries. Harrison?
Wait, wasn't like it called the 2008 Wall Street crash?
There are a lot of names for it. The main names for it are the 2008 financial crisis, and the resulting recession, which is, for those of you who might not know what a recession is, a recession is a period of slowed economic growth. And it's usually defined by two consecutive quarters. Two consecutive quarters of U.S. GDP decreasing. So there was a recession here, as you see right here in the chart. It says U.S. recessions are shaded. The most recent ended. Oh yeah, U.S. recessions are shaded. And as you see here, there was a major recession here that lasted from 2008 to 2009. But the crisis really lasted from 2007 to 2009, and the resulting fallout from the recession. I'd honestly say that the resulting fallout from the recession is still being felt today. A lot of people have faced immense economic and financial distress because of this recession, and it still continues today. So it's technically not over yet. A few more hands. Esther, did you have something else to add?
Oh, I was going to say that, like, wasn't it because people were taking out loans to buy houses because of really low interest rates, and then when
we'll actually
they couldn't.
we'll discuss this crisis in a little bit more detail in the future in the next few slides. So yes, I see Sean and then Nav. Anything else?
yeah, so since right now it's highlighted yellow, does that mean there's a recession now?
They're still calculating the numbers for 2021, but I'm very certain that we're out of this recession by now. It was just from COVID last year. Nav?
Yeah.
Okay, yeah, guys, make sure to lower your hands when you're done answering the question. Yeah, just be sure. All right, Harrison, did you have something?
I keep on forgetting to.
Yeah, no worries. Just make sure you do that so then we can we know what's going on. So back to mortgages. So very good answers about 2007, 2009 financial crisis. So mortgages, in the most basic terms, are loans that a borrower uses to purchase or maintain a house or other type of property. Two types of loans, two main types of mortgages. There are a ton of different types of mortgages, but the two main ones that you should know are fixed rate versus and adjustable rate mortgages. And this is what we talked about yesterday, right? So we don't have to go over it again. These are all talking about interest rates. For fixed rates, fixed interest, adjustable rate, adjustable mortgage, adjustable interest rate. Pretty straightforward. The property serves as collateral to secure the loan. So if you default on your mortgage, the bank, you can come and repossess your house, and that's called foreclosure, as we were talking about yesterday, as someone brought up yesterday. Okay, if all that makes sense, we'll go on to understanding credit. Let me know if that doesn't make sense. Okay, perfect. Let's go to credit. So credit is defined by a measurement that lenders use to determine how potentially able you are to pay back loans in a timely fashion. So your credit worthiness is what lenders look at before they approve any new credit or loans for you. So the more credit worthy you are, the better loans you have access to, because lenders view you as more trustworthy. Hold on just one second.
So lenders, because your credit is essentially how trustworthy you are. So what lenders look at your credit, it basically means how trustworthy you are. So when lenders are looking at your credit worthiness, it essentially means they're looking at how trustworthy you are and how likely you are able to pay back your loan, meaning the better credit you have or the more credit worthy you are, the better loans you will get because you're more likely to pay back your money. That's basically how it is.
Yeah, exactly. Sorry about the interruption. And thanks, Matthew, for stepping in. There's something going on in my house that's causing a bit of a disruption. All right, so let's look at credit scores. I have to share my screen here and then share sound. So this is a quick video that explains what credit scores are.
What are you gonna order? I'm thinking tacos.
Hey, have you checked your credit score recently?
What, you think I can't afford tacos?
No, I was just curious.
Oh, you just, well, yeah, I have checked it recently and I got like 100, which my guy says it's one of the highest scores he's ever seen. So, Taco Tuesday, here I come. What, you don't like tacos or something?
No, your guy? Come on. Everyone knows that the highest credit score that you can get is 1,000.
That's what I meant. I messed up the words. It was a flub. When I said 100, I just forgot the other 0. Different word. 1,000 credits is what I meant to say. Totally got 1,000 credits.
Okay, so to be clear, credit scores don't go up to 1,000. The scale runs from 300 to 850. And while I'm at it, there are a few other things you should know too. A credit score is a portrait of someone's credit history, made up of several factors that we'll cover in a moment. This number is placed on a scale that helps prospective lenders evaluate how likely you are to pay your debts. This in turn determines what kinds of loans you can get. There are 5 factors that determine your score, and they all have varying levels of importance. Payment history is the most important piece of your credit profile, and it accounts for roughly 35% of your score. Makes sense, too. If you've been responsible in the past, you can probably be trusted in the future. So avoid late payments at all costs. Amounts owed, or credit utilization, is the second most important factor, coming in at about 30% of your score. Now, this part is important because notching a good credit score doesn't mean that you don't borrow. In fact, not using your credit is almost worse than using tons of it. You want to show that you can handle a reasonable amount of debt without going off the rails. One of the more obvious factors in a credit score is the length of your credit history, which counts for 15% of your number. It's like in those old movies where a shop owner lets one of his regulars run up a tab because he knows he's good for it. Same goes with credit. The longer you've been borrowing, the better. Finally, types of credit and new credit each account for 10%. Types of credit reviews how many sources of borrowing you use, like a car loan, mortgage, and credit card. The more diverse, the better. New credit takes into account how often you take on credit you don't need, like applying for a credit card at 5 of your favorite new stores. So while you can't have a credit score of 1,000, you can make sure you're taking the right steps toward a great credit score. Come to think of it, I think tacos do sound pretty good right about now. Hey there, I'm thinking we should see more of each other. If you'd like to watch more,
Okay. Pretty straightforward explanation of credit scores. And I'll just reiterate what the video was saying. So the higher your credit score, the greater access you have to better loans, right? So better loans include, the terms of these better loans may include lower interest rates. So you pay less interest, shorter repayment periods, so you pay less overall, and lower periodic payments, or lower, usually monthly payments, and potentially more benefits. So basically, you want a high credit score. So then loans come easier to you, and you're able to you're able to have access to these better loans. Sean, that's quite the interesting fashion sense you have there. Distracting me. All right. So how is credit score calculated? So as the video was saying, 35% payment history, basically how far your loans, how far your history goes back, right? And also, have you been defaulting on your loans? Have you been making payments on time? That's your payment history. 30% amount owed. So how much debt do you owe, right? And usually you want to owe a healthy amount. You don't want to owe like not a lot, because then it shows that you're not using your credit. 15% length of credit history. So this is like how far does your credit history go? This is slightly different from payment history. Sorry, payment history. I mixed up the two a little bit. Payment history is whether you've been making stuff on time, or making payments on time as you take out loans. Credit history, length of credit history is how long have you been taking out loans, and you want to start as early as possible. Usually, you're able to once you're 18. So a good idea is to start as soon as possible when you're 18. Maybe get a credit card to show to just kind of establish your credit history early. 10% new credit, and of course 10% credit mix, or basically the variety of type of credit you have. Like, do you have only personal loans, or do you only have credit card debt, or do you also have a mix like mortgages? Are you like basically trying to see, can you handle multiple types of credit at the same time? And if you can, then you're more creditworthy. You have a higher credit score. This is really basic, but some of the most fundamental steps to improving your credit score include making payments on time, right? So you can boost your payment history, asking for higher credit limits. So does anyone like know this term, does anyone know this term, like quote unquote, maxing out your credit card? Does anyone know that? Yeah. So what that means is that your credit card has a limit, right? It has a credit limit. You can only borrow up to a certain amount. It's not infinite. It's not infinite. What you can usually do though is that, if you're showing that you're creditworthy, if you have a good credit score, you can call the credit card company, or this is usually regarding credit cards. You can call the credit card company. You can ask them to raise your credit limit, and that can boost the amount of debt that you could possibly owe, and that will help boost your credit score. What's next? Okay. Disputing credit report errors, right? So when you look at your credit report, and we'll talk about credit reports in the next slide, but basically, if you see errors, if you see that they're messing up your calculations somehow, or they're missing something from your credit report, then you want to dispute that, right? You want to call them, you want to call the credit bureaus, and then you want to make sure that they fix the error, so then you don't have a lower credit score than you're supposed to. Another thing right now is becoming an authorized user on a credit card. So basically what that means is you can become an authorized user on, for example, your parents' credit card, so then you can start building credit before you're actually able to get your own credit card. So that's something that you can talk to your parents about if you'd like. And if this is all about, trying to establish a long credit history. What's next? Okay, yeah, keeping credit cards open. So you don't want to close credit cards, because that actually messes with your credit history. If you keep credit cards open, that actually prolongs your credit history, because if you close it, all that history is gone. If you keep it open, all that history with your past credit card still exists. And this is assuming that you did well with your past credit card and you were making payments on time. And finally, mixing up your credit type, right? If you're just doing credit cards, maybe if this applies to you, then maybe you look into possible other types of credit. But this is 10%. The main ones are, making sure you're making your payments on time. And yeah, that's like the biggest one, actually. All right, so let's look at credit score reports. Sorry. Put the wrong thing there. So a credit report is a detailed breakdown of an individual's credit history prepared by a credit bureau. So lenders use these reports to determine the potential borrower's creditworthiness, right? So this is the report that calculates your credit score. The three major credit bureaus, which are Experian, TransUnion, and Equifax, they're each required to provide consumers with one free report each year. So you can technically get 3 reports each year if you request them at, best at different intervals, so you can spread them out. So regarding these credit score reports, it's really absolutely crucial that you check for these errors and potential areas for you to improve your credit score. When you receive your credit score from one of these credit bureaus, you want to see, number one, did they make any mistakes in calculating my credit score that is actually lowering it? than what it actually should be? And number two, are there some weaknesses in my credit score report that I can improve on, that I can immediately try to improve on? So there's that. So credit, does that make sense to people? Do people understand what credit is? Please send a message to Matthew or raise a hand if you have any questions regarding this. All right, moving on then. So let's talk about predatory lending. So predatory lending is generally defined as any lending practice that imposes unfair and abusive loan terms on borrowers. So examples of this practice include high interest rates, like really high interest rates that are just absolutely egregious, that can allow you to incur really large amounts of debt, high and hidden fees. I don't remember if in Shady Sam yesterday, there was this option that allowed you to impose this hidden fee on people. So yeah, hidden fees are part of it. And also just in general, other potentially abusive loan terms. So that's predatory lending. If you recall Shady Sam, we were looking at a loan shark who was engaging in predatory lending. So you are all quite familiar with this. So then this question is, who gets targeted by predatory lending, and how do we watch out for and protect against predatory lending? And this is a huge public policy issue, right? This is a huge social issue, because oftentimes it's the poor, it's the working class that gets targeted by predatory lending, because they might not have good credit scores to take out credit cards or get loans from a bank, right? Because banks see them and they see their lower credit scores, and they don't give them, they don't lend out money to them. So oftentimes they have to resort to these places, and they're quite desperate, and they can get taken advantage of. And how do we watch out for and protect against predatory lending? Well, there are multiple policies that have been enacted to protect against predatory lending. Some effective, some not. Predatory lending is still quite prevalent in the United States. It's an ongoing issue that we still have to solve. Let's talk about, hold on. Oh yeah, sorry, we were on this section, understanding loans in real life. Okay, so let's go back to the 2007-2009 financial crisis. So we already kind of went through this, but quickly, just it was a global meltdown of financial markets originating from the U.S. housing market. This led to a severe recession, causing massive unemployment and financial distress around the world. Why did it happen? A prevalence of cheap credit, right? So cheap credit means credit that was really accessible to everybody. Like, it was really easy to get a loan. It was really easy to get a mortgage. So cheap credit and relaxed lending standards. So oftentimes for mortgages, when you're underwriting a mortgage, you have to jump through a lot of hoops, right? You have to prove to the bank that you're creditworthy. In the 2000s, a lot of banks lowered their standards just so they could pump out more loans, and pump out more mortgages. And the reason for that doing so is a whole other issue that I'm not going to get into now. But basically, bad loans, worthless investments fueled the housing bubble. A lot of people were taking out mortgages. They had lower credit scores, or maybe they didn't have a credit score, maybe no income. And once they did that, and they couldn't pay down their mortgage, that's what led to the housing bubble, right? Any questions there? Okay. So I found this crisis really interesting, and I actually did my own research on this, and the title of my paper was "Cause Determination of the Adjustable Rate Mortgage Market Collapse During the Financial Crisis." So I specifically looked at the adjustable rate mortgage market and why it had collapsed. And ARMs were this huge quote unquote culprit in the financial crisis, and people were talking about how it was caused by these massive subprime, or basically subprime means like worse, like usually lended out to people. Subprime loans are usually lent out to people who have lower credit scores, who don't usually qualify for prime loans, right? So subprime adjustable rate mortgages they were labeled as this culprit for causing this market collapse. And my paper kind of talks about how that's not necessarily true, and it's yeah, I added a few things that they should consider rather. So that's kind of my experience with researching the financial crisis. So I'm just trying to show that, you know, it's really interesting stuff, and it's stuff that people can explore further on. It's, you know, and it's quite important as well, right? Because we want to know how financial crises work, so we can try to work to prevent the next one, or, you know, try to limit the effects of the next one. All right, so then now we're talking about the American student loan debt crisis. So my question is, how much debt do you think American students owe in total, like in aggregate, like everybody added together? Sean, give me an estimate.
1.1 trillion, 1.17 trillion. Is that what it said on the chart game?
Perhaps. I have the answer. Does anyone else want to throw out a guess? Nav?
2.1 trillion?
2.1
No, that's a bit wrong.
2.1 trillion. Okay. Anyone else? Freya?
2 trillion?
2 trillion. Okay. Marco?
Like 6 trillion.
6 trillion. Okay. Andrew?
1.4 trillion.
Dante?
Can I give it?
Wait, Dante. And let's make this the last guess. Dante, what is your guess?
6.8 trillion.
6.8. Okay. So Freya, were you the one?
7.2.
Okay. Freya, did you say 2.0?
Yeah.
Okay, I think you were the closest one, unless someone also said 1.4, because the answer is 1.7 trillion.
I got it. I got it correctly. I said 1.7.
You said 1.17.
I said, oh crap.
I said 1.4.
So very they're both the same. Sorry, they have the same difference, but they're on opposite ends. But yeah, 1.7 trillion at the end of 2020. That's 7.9% of America's GDP in 2019. So that's enormous. So basically, more students who have taken out educational loans or, you know, student loans are struggling to find work. They can't pay off their student loans, right? And guess why? The financial crisis. The financial crisis has made the financial crisis and the recession has made getting a job and getting a good job really rough in the last decade. So people are unable to find people are unable to find jobs and get good pay as they enter the workforce. So they're unable to pay off their student loans. So as a result, student loan debt has skyrocketed in the past decade. So these two are very interconnected here. So some things to consider. So, you know, what are, you know, current student loan laws? They're quite unfair, actually. Like a lot of it is, and I was talking about earlier today, like, you know, when you default on a student loan, they don't give you any leniency. Like, first of all, there's no collateral, right? It's unsecured. And what happens is your credit score plummets, right? Because you've defaulted on a loan. And then it makes it really difficult for you to try to get another loan, rebuild your credit score later on. And then you, of course, you have to figure out and you have to negotiate with your lender on how exactly you're going to be able to pay back that student loan, right? Even once you've defaulted, and it can cause a lot of people to go bankrupt. So current student loan laws, quite unfair. We need a lot of changes. There's been a lot of talk ever since, I think there's been a lot of talk for a while now of student loan forgiveness. And that's something that's been in the conversation of public policy regarding this crisis. So some things to consider there. Impact on economic conditions, right? What does student loan debt cause? How does student loan debt impact the economy, right? what happens as this new generation of young workers are bogged down by debt and they're unable to consume, or they're unable to, be as productive, right? So that's something to consider there. And, another thing to consider is, what about your own future, right? So your own education, your finances. When you take on student loan debt, you have to be careful, because you might join this group of people and your sum might get added to the 1.7 trillion, right? So you have to understand, what exactly you're getting into. Are you going to be able to pay back your student loan debt? So are you going to be able to pay back your student loan debt? Well, let's find out. I have a quick financing college game for you all. It's called Payback. So the overview of this game is that, you are all in quote unquote the driver's seat as you make decisions and you try to get through college, right? So some tips, very similar, kind of similar to the magician game, right? You have to pay attention to various different bars, make sure that you keep track of all three of them: focus, connections, happiness. Otherwise you're screwed, right? Otherwise you lose. So the winning condition is that your total debt after graduation, after your senior year, after 4 years, should be less than the starting salary of your chosen major. So you don't have to be debt free when you graduate college. What you do have to be is less than the starting salary of your chosen major, if that makes sense. So let's get started. Nav, you had a question?
No. That was the last slide.
No, wait, then we should just choose the best starting salary one, since because that makes the most sense.
Right, but Sean, what exactly do you want to get into? Do you want to get into a job that pays a lot but you hate it, right? Because you want to simulate real life here. But here's the link. Time for payback. Looks like we'll be going over a bit over time, so I apologize about that. But this is a really interesting game. Matthew, if you could hop into on the game for timing purposes. And what we'll do like last time and the last few times is that everybody close their cameras, or turn off their cameras, and then once you're done, turn them back on, and we'll have a quick discussion, and then we'll wrap up for class. Sarah, you had a question?
Just that I'm currently traveling and I don't think I can play the game.
Oh, I'm sorry to hear that. Matthew is going to. Sean, the link is right above you.
What do you mean right above me? The link isn't like in it. The only message before my message is the 11 trillion by Wang Jerry.
Oh, sorry. I messaged everyone. Hold on, in the waiting room. Okay, there you go. Sorry about that. Yeah, no, Sarah, I heard you. So basically, what we do every time is that Matthew sends out the game link afterwards. So if you have any time in the middle of your travels and you're able to have access to computer, try it out. I think it's a very, very good experience. But the link is there for you, and we'll have it on the Google Classroom. So
hey, Brian.
Thanks for coming in, Sarah.
It asks for my GPA and a bunch of other stuff. So do I just like spam him in the max, or do I just like try to spam to get the best result, or do I just like type it in honestly?
I type it in honestly. So then you really know what situation you might be in. But yeah, I'm really up to you, Sean. It's really up to you. So
I'm pretty sure I don't have
You guys
GPA
don't
yet.
have to worry about that.
Yeah, I mean,
I'm pretty sure I haven't gone through any of the high school testing and stuff, so I guess my GPA is just 4.
Yeah, I mean, just give an estimate of what you might have in high school. Once again, it's really up to you. So this doesn't have to be specifically. Yeah. Andrew, you got a question?
For the middle one, what should I type in? It says like, I don't even know how to pronounce that word.
What is the word?
It starts with an E,
Oh,
EX.
extracurriculars.
Yeah.
So that's how much extracurriculars are activities that you do outside of school, right? So how much are you involved with stuff outside of school? And you can give like an estimate of that as well.
I'm just gonna put like the medium for everything.
Sure. All right, I'll see you all in a bit. Oh, sorry, Teddy, you got a question?
Just for all courses or just one course?
Regarding what? Your GPA?
Yeah.
Once again, that's really up to you. You don't have to be accurate. It's a simulation, right? You can choose however. You can also challenge yourself and see where you might be if you have different GPAs, right? Really, once again, it's up to you. You don't have to be accurate. But if you want to simulate yourself, you can do that as well. So, all right, I'll see you all in a bit. Resume recording. Okay, so we can wrap up class right now, and then you guys can keep exploring the game, seeing how you do based on your scenario, and then we'll meet tomorrow for our final class on investment. And yeah, if there's any questions, feel free to ask myself or Matthew. And yeah, make sure to be on the lookout for after class work. I'll be sending out the after class work for today soon. And there was this question about presentation slides. We will be, I'll try to get out presentation slides on Friday so you all can keep the information that I created. So yeah, I'll see you all tomorrow. Take care.
I'm in $3,000 student loan debt.
Thank you.
Yay.
Thank you. Bye.
Bye.
Thank you. Bye.
Bye.
I got to 11,000.